Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, August 20th. The market sentiment is rattled by an MIT report that highlights that most companies that invested in AI are yet to see their benefits, and on some Altmans warning that tech valuations are insane. So the news comes just before the Fed President Jerome Powell's Jackson Hole speech that is due later this week on Friday that could also pour some cold water on the dovish Fed expectations. So investors are getting tense and we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So a sell-off across the US big technology names dampened the market mood yesterday. The move was mostly triggered by mounting doubts over the AI boom of the past 2 years and a half after an MIT report revealed that 95% of companies investing in the generative AI have yet to see returns. And also OpenAI CEO Altman himself warning that the sector may already be in a bubble territory, calling the valuations insane. So his warning came as a moment for investors, really sparking a sharp pullback in high-flying technology names. So Palantir, which has a PE ratio above 500, meaning that the stock price is valued at more than 500 times its earnings, actually plunged nearly 10% at yesterday's trading session. Nvidia, with a PE ratio of around 56, which is much less, but which will likely be pulled even lower with next week's earnings, but still slid over 3% yesterday, and other AI-linked stocks like ARM, Oracle, and AMD also lost ground. So the technology's weakness dragged the Nasdaq index down around 1.5%, which was the steepest drop since the start of the month, while investors rotated into more defensive names in more defensive sectors such as utilities, real estate, and consumer staples. Now, not that Intel was a rare bright spot at yesterday's trading session. The company added 7% indeed the day after it lost up to 5%, but the day before it had gained 7%, mind you. And this market volatility for Intel has been going on since the beginning of the month of August on various news and reasons. First, Donald Trump wanted the CEO Lip-Bu Tan to resign because he has a solid and quite long track record for investing in Chinese technology companies, and that didn't really please Donald Trump. But wait, then Mr. Lip-Bu went to the White House to meet President Trump, and the meeting went well. And it went so well indeed that the White House right after announced to take a big stake, around 10%, in the company without governance rights. So the news hardly pleased investors around the world, obviously, on thinking that the US government is going to do this to boost production in the United States without, however, caring whether the chips that will be produced in this Ohio chip would find end users. But yesterday, the Japanese technology investor SoftBank will also announced to be joining in and announced that they will be buying $2 billion of stake in Intel. Though the deal must be somehow backed by political sweeteners, SoftBank genuinely wants to design and eventually build a chip to compete with Nvidia in the AI space. And if Intel could help them to do it, there could be a good and interesting synergy there. And the latter would also give Intel a seat in the AI room, a seat that the company couldn't secure for itself since OpenAI saw the daylight and Nvidia just took off. And last quarter only, the company Intel announced a $3 billion loss. So the plan here is for the US government to revive Intel and SoftBank to take part of it. SoftBank actually plunged more than 10% since the news broke, but a part of that sell-off is certainly linked to the overall stress that there may be a bubble in the technology prices as the company holds big chip names as Nvidia, TSMC, and ARM, and these are quite highly valued right now. And if there is a bubble that is to burst, companies with relatively lower valuations, so PE and price to sales ratios, strong earnings, and decent cash flow will be less harmed than the others that and those particularly that are purely pushed higher on AI hype without, however, earnings following. So the easiest way to see who is more vulnerable to sharper losses is to check the P ratios and valuations and eventually tidy up portfolios. For high conviction trades, but investors are not necessarily willing to miss the upside potential for a company, but willing to still limit the potential downside risk. The put options are increasingly popular these days, mind you. So put options are basically the right to sell a stock or an index at a predefined price at a predefined time. Well, you can see it as price insurance for a stock. You pay a premium to buy it, and the premium depends on factors including the exercise price and the volatility of the market, and then you are protected against a downside risk. So investors are now rushing into what is called disaster puts these days. So disaster puts are the puts that will protect investors against a downside correction, and the put skew, the cost of contracting put options versus call options, rose to a nearly 3-year high according to 22V research. Now note that insane valuations for big technology companies are only part of the building stress in the market. A part of it is also due to a backdrop of caution ahead of Fed Chair Jerome Powell's speech at the Jackson Hole meeting due Friday. The latter is also keeping markets and investors on edge about the Fed's policy outlook, as the dovish Fed expectations and September rate cut bets have gone well ahead of themselves since the U.S. Treasury Secretary Mr. Scott Bessent actually threw in the idea of a possible 50 basis point cut at next month's monetary policy meeting. Well, that probably ain't happening, I'm telling you, but a comment like that has made a 25 basis point cut from the Fed next month look almost certain. Certain against the Fed's cautious tone regarding the possible inflationary pressures, of course, due to the tariffs. Now, even though consumer prices in the US seems like they're resisting to price hikes, well, the producer prices last month actually showed a sharp spike in PPI index, saying we're coming at you. So the Fed Chair Jerome Powell is now sitting between a rock and a hard place. He's pressured by the US government and Mr. Trump himself to lower the interest rates, because if he doesn't do so and the jobs reports in the US continue to show a further weakening in the jobs market, then he will be pointing at, for the second time in his term, for being too late. And Mr. Trump himself already calls Mr. Powell Mr. Too Late for having missed the COVID-led inflation surge. But if Mr. Powell does lower the interest rates and inflation spikes all of a sudden, along with the tariff pressures, well, he will then find himself with high inflation and high unemployment to manage. And there is nothing worse for a central banker than that. It is called stagflation. So the famous stagflation is high inflation, high unemployment, and that's really hard to manage. So investors are waiting to see how Powell will make his way out. The US 2-year yield remains near 3.75%. The base case expectation is a 25 basis point cut in September and another cut before the year ends if inflation doesn't spike. Of course, a dovish boost to that expectation is highly unlikely, so there is a higher chance that we will see some hawkish readjustment to that Fed narrative of the moment. So if that's the case, we could eventually see the US yields bounce higher, the US dollar extend its nascent recovery, and the equity sell-off accelerate. But don't worry too much, because 22V Group, actually, which is the one that warns that investors are now rushing to buy put options to hedge against a potential market meltdown in the coming weeks, also says that over the last 18 months, while the average pullback in the market has been around 12.5%. So we may eventually not see another 20% meltdown in the market as it has been the case in April. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Thread, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.